Greetings and welcome to my YouTube channel. Please do not forget to subscribe, like, and share, and also click the ring button there so that you get notification of each and every video that I post. Okay, so today I'll be preparing general journal using the periodic inventory system. Okay, so if you see here, I have elements of financial statements. Elements of financial statement that are going to help us to debit and credit. It's a toolbox that I'm going to use. Okay, so let's see. They're saying the following the following inventory transactions of Mayweather took place during the month of May 2019. Transaction number 1. That happened on the 5th of May. Bought inventory and paid cash 80,000. Okay, so there we need to identify 2 accounts affected, and then we're going to follow the elements of financial statements to assist us which one to debit, which one to credit. Okay, so bought inventory and paid cash 80,000. 2 accounts affected there is inventory and bank. Whenever you see cash, you must know bank is involved. Okay, so but when we are preparing general journal like this using the periodic inventory system, inventory is going to be called purchases when we record, right? So, but when you check there, we bought more inventory. We've bought inventory, so that means there's more inventory coming into the business. So there's an increase in inventory per se. So when we record inventory, we're going to debit because there's an increase in inventory. Okay, there's an increase in inventory. So, but since we're using periodic inventory system, we're going to debit purchases there. We're going to debit purchases. Why? Because purchases or inventory is an asset, right? And whenever asset increases, we must debit. You see there. So I've debited my purchases, and then I'll go to the debit side there and indicate the amount, 80,000. 80,000 rand. And then another account that is affected is bank, as I said, right? Because cash is involved. And here, bank is decreasing because we are making a payment of the purchase of inventory, right? So therefore, our bank is decreasing. And whenever bank is decreasing, we must credit because bank is an asset as well. Bank is an asset as well and is decreasing. And whenever asset decreases there, we must credit. Okay, so we'll go there and say bank on the credit side, the same amount, 80,000. So the debit side and the credit side are balancing there. Okay, and then let's go to the next transaction there. The next transaction that happened on the 9th says sold inventory on credit to L Lucky for 20,000. Sold inventory on credit to L Lucky for 20,000. Okay, so 2 accounts affected there is debtors control and sales, because we sold on credit. So the person we sell to on credit is a debtor. Okay, so that's why debtors control is affected. And what is debtors control in terms of the elements? Debtors control in terms of the element is an asset. Okay, so it's increasing because we are having more people that are buying on credit. It means we have an increase in debtors control because we received a data that bought on credit. So in terms of the elements, remember, debtors control is an asset, and whenever asset increases, we debit. So we'll go there and say debtors control. Debtors control there. Debtors control there. And then we will credit sales because we sold, right? We sold. So when we sell, we're going to call the account sales. Why are we crediting sales? Sales, it's an income account. And whenever it's increasing, because when we're selling, it means we'll continue to sell. There's an increase in sales when we sell, right? And sales, it's an income account. And whenever incomes are increasing, we must credit. That's why we're crediting sales. So with how much? 20,000 rent there. And then also sales 20,000. Right. Very easy. Okay. Then let's go to transaction number 3, which happened on the 15th. They're saying issue a credit note for merchandise to L Lucky 5,000. So whenever we issue a credit note to a debtor, it means the sales returns. It's like the debtor has returned certain amounts of goods. Right here we see L Lucky that we sold goods to in transaction number 2 that happened on the 9th. He then came back on the 15th and returned goods of 5,000. Okay, so when the sales returns like that, it means 2 accounts affected is going to be sales returns and debtors control. Why? Because L Lucky was owing us 20,000. Whenever he returns the goods of 5,000 from the goods he purchased of 20,000, he's no longer owing us 20,000. So there's a decrease of debtors control by 5,000. So when we get here, we're going to debit sales returns. Remember, sales is an income account, but when it's returned, it's going to decrease our income, right? So sales returns 5,000 there. 5,000 there. Sales returns 5,000. Okay. Sales returns 5,000, and then debtors control 5,000 on the credit side there. 5,000. Okay. Sure. And then we go to our transaction number 4. Transaction number 4 that happened on the 17th. Transaction number 4 that happened on the 17th. It says cash sales. It means we sold goods for cash. We sold goods for cash. 2 accounts affected is going to be bank and sales because we sold goods for cash. So it's going to be sales and bank, right? And then we're going to go there and debit bank, because when we sell for cash, it means we are receiving money. Our bank is increasing because we are receiving money. As we sell, we receive money, bank increases, right? And then we're going to debit bank because bank is an asset. And whenever asset increases, we debit. So we're going to go there and say bank, okay? Bank, and then we're going to credit what? We're going to credit sales because whenever we sell, we are getting more income, okay? We are getting more income. So bank is going to be debited by 30,000. And then sales as well. We're making an income of 30,000 through sales. 30,000. Therefore, remember, bank is an asset, and whenever asset increases, we debit. Sales is an income account. Whenever it increases, we credit. Okay, easy as that. And then let's go to the next transaction, which is the transaction that happened on the 19th. Transaction that happened on the 19th says freight paid on purchases. Freight paid on purchases. Freight paid on purchases. 2 accounts affected there is freight fees or freight charges. You can say freight fees or freight charges. So freight fees or freight charges are expenses, right? So freight charges and bank because we paid, right? So 2 accounts affected there. It's freight charges or freight fees and bank because we paid for cash. So freight charges or freight fees are expenses. Whenever we have an expense, we debit whenever expenses are increasing. We're going to have increase in expense, freight fees or freight charges. So when I go there and say freight fees of how much? Freight fees of 500. Freight fees of 500, and then we paid for cash. Bank is decreasing, it's an asset. We credit bank, okay, and then 500 there, okay. Remember, I'm not just debiting, crediting. I am following the elements. So always remember, this must be your toolbox. This must be your guideline. The elements must be your guideline. So let's go to the next transaction there. Let's go to the next transaction. Transaction happened on the 20th. The owner took goods for own use. The owner took goods for own use. Two accounts affected. There is going to be drawings and inventory. And inventory, when we are using periodic inventory system, is called purchases. Remember, as I explained from transaction number 1. So it means we are going to debit drawings. Drawings, it's an owner security account. Like when the owner is withdrawing from the business, the ownership decreases, right? That's why we're going to decrease our ownership there, because drawings is an owner security account, and whenever ownership is decreasing or owner security is decreasing, we debit. So I'm going there and say debit drawings. I'm going to debit drawings there. Drawings and credit purchases, because he withdraw inventory. He withdraw inventory. And inventory, when we are using periodic inventory system, is called it's called purchases, okay? With how much there? 500, I mean 500, and then 500 there. Okay, right. And then the last transaction, they are saying returned damaged goods to the supplier, 2,500. So here it's you as a business, you are taking back damaged goods to the supplier, right, that you purchased. So whenever you take damaged goods to the supplier, your suppliers are called creditors here, okay? So it means here you are going to debit creditors. Two accounts affected today, creditors and inventory, which are goods, right? Which are goods that you purchased, okay? So two account affected, there's going to be creditors and purchase returns, okay? So remember, whenever you buy goods on credit, we increase inventory on the, we increase your creditors in the credit side. Whenever you purchase inventory on credit, we increase creditors on the credit side, right? And then, but now you are returning. When you return, it means your creditors are decreasing. Because if, for example, now you are owing your creditors 5 rand, and then, or you bought your goods from your creditors by 5 rand, and then you return 2 rand goods that are damaged, you are no longer owing those people 5 rand. You are owing them 3 rand because you have returned the goods of 2 rands. Therefore, there's a decrease of creditors. Okay. I don't know if you get this example, but if you're gonna repeat listening, you will understand why I'm gonna debit creditors. I'm gonna debit creditors because they are liabilities. They are liabilities. Creditors. Control. Creditors control. Creditors control there, right? Because your creditors are decreasing. And whenever creditors are decreasing, they are liabilities. Whenever liabilities are decreasing, we debit. That's why I'm debiting your creditors there. And I'm going to credit purchases returns. I'm going to credit purchases returns because I'm returning goods as a business to the suppliers. Purchases returns. Purchases returns there of how much? 2,500. 2,500. 2,500. Okay. So yeah, that's all. So to explain this is that creditors are debited because they are liabilities and they are decreasing. That's why I'm debiting. And then purchase returns. You are returning the goods that you have purchased to the creditors. So that is an asset. Purchases, remember, is an asset. And whenever it's being returned, it's decreasing. Remember transaction number 1 up there. When we buy, they were increasing, we debited. But now they are decreasing because we are returning back to the supplier. That is why purchases is being returned and is decreasing. I hope that one you understand. Thank you. Thank you, and thank you very much. Please do not forget to subscribe, like, and share. And also click the ring button there, that when I post another video, because the next video is going to be perpetual inventory system. We're going to do general, and then it's going to be about perpetual inventory system, and then you see what is the difference between perpetual inventory system and periodic. Today we're doing periodic, so it's better for you to get a new video quickly when I post it. Just click the ring button and then you'll be sorted. Thank you very much, and I salute.